Our market update on April the 13th. Happy spring to everybody out here in California. I hope everyone else is having a good day and a good weather day. So we started this topic with the sort of after the stimulus bills, what's next? And to give you the quick answer, it really follows here. Things are in pretty good shape with the economy, given what we've all gone through over the last 15 months. So as we're sort of sitting here halfway through April, we know that economic growth will bounce back sharply in Q2. Obviously, the quarter is only 2 weeks old, but all the indications, early indications like various openings, mobility measures, so gauging how many people are actually moving around, and we can track that with Apple data, for example. People booking more restaurants. Certainly, flight numbers have ticked up. So there's generally, a feeling that the activity is picking up in a pretty sharpish way. So we'll start to see those 2Q numbers really accelerate, and even Q1 growth, which we haven't quite seen the first estimates of. We'll see them in a couple of weeks. They're probably going to show growth in the region of 6% or so from an early estimate of 4%. So things are coming back. So that's the first thing from the stimulus. The consumer revival will be fast and broad. Obviously, everybody knows that there's been a certain amount of pent-up demand. That's the next item that we have. Services. I throw some caution over that a little bit. People can't make up for missed restaurants and eating out. You can't sort of go 7 days in a week to make up for a month of not having restaurant services or longer. You can't have twice as many haircuts and so on. But there is obviously going to be a lot of pent-up demand for travel services, hotels, airlines, and so on. And they've already shown up in many of their stock prices. And I think that will be the big move in Q2. We've mentioned this before, but I can't emphasize it enough. We really have an unprecedented level of savings in the economy. I'll show you a chart later, but those of you who remember the 80s when everyone was looking at the money supply, M3, M2, M1, and M0, they were popular for a while. And there's a certain amount of economic thought. The monetarists are a bit out of favor these days, rightly so, but the M2 numbers are staggeringly high. That's really showing up with people's savings in checking accounts, side accounts, and various savings accounts. Now, bank money, which they can get to very easily. So we're at 74 million vaccinated, as I checked yesterday. I was up 14 million over the last month. So in whatever it is, that's 2 million every week or so. It's going exceptionally well, actually, more than that number. And even today, with the disappointing news about Johnson & Johnson pulling some of its vaccinations for a while, I think we're still on good shape for the herd immunity to kick off. That depends on what you kind of view as herd immunity, but most people seem to think we're only a couple of months away at this point. The bond market did sell off quite a bit. That was the story when we met last week. It did continue to do so, but now it's stabilized a bit. The Fed is not interested in really forecasts on inflation or rates or growth. They're going to be looking, for the whites of the eyes of the data. And so far, the data is really not there. Even with today's CPI numbers, which I'll touch on in a minute, there's probably not enough there for the Fed to get too excited about changing policy. So the Fed will wait until they start to see activity really coming back on a consistent and stable basis before they do anything. Brace for inflation stories. We're going to hear a lot about it today. As expected, dead on time, the CPI year on year is up 2.5%. We all knew that was coming. It was the most obvious piece of data, surprise. But nevertheless, I've already picked up a couple of headlines from Bloomberg saying, consumer prices advanced most in 9 years. It's going to go, well, yes, but that's really got some extraordinary base effects. And what I mean by base effects, well, if you just cast your mind back to 12 months ago, if you were a retailer with a lot of inventory and you just got shut down, you'd want to get rid of as much of inventory as you could. So you'd just drop your prices. Same with the restaurants, food, anything that was going to face, had a finite shelf life, you're going to push the prices right down. So that's that's really what we're dealing with. That people, there was a kind of a deflation problem. I wrote about this in the blog. Deflation problem throughout the second quarter of 2020, and we're not in inflation era. We're just kind of going back from having less of a deflation problem, and hopefully no deflation problem at all. But it really is this base effect, which which is pretty important. But you'll hear a lot of chatter about this. I wouldn't be surprised if it hits the news and everything else, and everyone starts getting excited about it. But I just say, stay calm. There's really no evidence that the inflation is going to kick up to a permanently higher level, at least not anytime soon. Stock's been taking a breather. Well, I wrote this yesterday afternoon. Of course, we're a record high today. So, stocks have been sort of crawling up. Obviously, had a phenomenal. The 12-month numbers are out of sight right now. I mean, just to give you a quick idea, the S&P, again, that's a base effect because we had that very worrying correction in March last year, bottomed out March 23rd. But if you take the 12 months number on the S&P, they're up 85%. Sorry, on small companies are up 85%. S&P is up 50%. Mid caps up 66%. Even value, which has been a long time slow mover, is up 44%. Not as much as growth, that's up 66%, but you can see that everything's moving, and that's what I mean by the broadening out. We've got no negative sectors anymore. The tech is still the leading sector on a yearly basis. Utilities lagging at about 11%, but they're a bond proxy in the most part. So that's a pretty good number for utility business. And so everything's really has broadened out, and that's a good thing. We didn't want it to constrained. There are some areas of excess. I mean, crypto is pretty high, although we've kind of turned around on that recently and think that's actually got a quite interesting future. Other things like the non-fungible tokens, SPACs business is just basically a reverse IPO that gets avoids having to go through all the listing requirements, and it means that companies that normally under an IPO, you can't give forward guidance statements. You've got to talk about what you've done over the last 12 months and 15 months. You can't give forward guidance to an IPO, but you can if you're in a SPAC. So, weirdly. So there's just a kind of almost a regulatory arbitrage which is going on right now. But a SPAC is, just think of SPAC as just a quick way to get an IPO. Special purpose acquisition company is what it stands for. But there's a lot of them going on. Probably too many for my comfort. IPOs are probably going well. We've had a number of them. A few have flunked out, but not many. And we got Coinbase coming on Thursday, which is probably going to be a very, very big one. And there's been excitement up and down about electric vehicles and everything associated with electric vehicles. And I saw an estimate the other day which said that there's 10 electric vehicle companies that have zero revenues today, expecting to get $10 billion of revenue within 3 years. Well, the record for a company to get to $10 billion of sales is Google, and they did it in 6 years. So it's difficult to see that 6 electric vehicle companies will do it, all at once. So especially as there are competitors here. There's internal combustion engine competitors, and there's a lot of major car companies who are going to come around. So I think just the EV side, the electric vehicle side is going to be braced for some fallout. Not everyone can deliver on the numbers which they're promising. I put this Archegos down. You probably haven't heard of it. It's no real need to. I've written about it, but it's essentially a hedge fund that blew up, and there was just a lot of leverage involved in that. And so these things kind of happen at the top of the cycle. I've been writing things about it's that time again, and you kind of get people moving from fear to greed and feeling that, hey, there's a chance to make a lot of money. They just rediscover leverage again. It happens about every 5 or 6 years. And these types of investments do very well, and then some of them have spectacular crashes. So, these are kind of things which are going on in the background. Not enough to worry about, taking the system down or being a broad-based, problem which the Fed has to react to, but they are around. You have to kind of keep your eye out for that. Yes, let me get the next one. So, we are seeing cases and hospitalizations. They're kind of leveling out. This is the new confirmed cases in the US. You see they're bottoming out, but it's very bifurcated. You kind of got Minnesota, Minneapolis, and Illinois bringing everyone down. But generally, these cases are at about the 45,000 level. And that's okay. I think, you know, the same, the vaccination is obviously, it'd be nice to be lower, but the vaccinations are taking place. So these are at least you know, not deteriorating to any extent on the national side. You know, deaths tend to lag cases, obviously, so that's been a bit that's that red number, green number, sorry, and that's been a slight uptick in there. But I mean, it's sad to see any kind of uptick in any of this stuff, but it's not material, certainly not like what we had to go through last fall. 3 million vaccines a day, so we've got 45% of the people vaccinated. You know, for the adult population, it's pretty high as well. It's more like, yeah, 45%. The total population is about 35%. So the adult population is people over age 18. So a month ago, this was 1.2 million 2 months ago, 9%. So that's a big increase. So you've doubled, more than doubled the rate of daily vaccinations. That's probably set to increase, won't double again in the next month, a couple more months, but it will continue to climb higher. And obviously the vaccination rate is going to continue to climb up to that magic number of 75. Elsewhere in Europe, this is kind of where we were. I think I can't read my own slide here, but I think this is where we were in January. But just take a look at where the United States has gone from the top right to where it is now, and we've come, you know, way down. So let me just get rid of this so I can see it. So you can see that, you know, the US was really lagging here, and now it's this is kind of this dark blue line. It's obviously done really well on the vaccination side. I mean, so is the UK. And so it seems like the guys who are the laggards on the case rate have really come through on the vaccination rate. I don't know if that's cause and effect or just, you know, getting your act together after a pretty hard hit. But anyway, we've got the vaccinations going now, and the caseload seems to be improving. So yeah, we're there with Germany. Germany is upticking for various reasons. The vaccinations have been very slow to get through to Germany. So good, you know, good population discipline. They kind of stay inside when they're told to and wear masks when they're meant to. And no one's, and a lot of it's closed down, but they haven't got the vaccination rates going yet. So there we are, sitting at the same level as Germany, which is quite an achievement considering where we were in January, where we were, you know, almost 7 times their rate. So this is definitely a good story on the confirmed cases. Yeah, this is, I put out the 5 biggest states just because, you know, New York, Florida, here we are in California, Texas, Arizona. California is sort of sitting at the bottom there. That's good. It was the second highest back in December. And these are just the rolling cases, new cases per 100,000. So that kind of takes out the population factor. But anyway, this is 38% of the population, 40% of GDP. And these guys are, you know, definitely moving in the right direction, although, you know, there's some sideways move here, and Florida inevitably has got, I say inevitably because they were asking for it, the way they opened up too soon and then coincide with spring breaks. So you kind of got the Florida uptick there, but, you know, maybe it'll level out from here. Good. So that's the kind of COVID side. And, you know, I think, I'm not sure if I think we're sort of seeing the light at the end of the tunnel. You know, this is something which is moving in the right way, and we're seeing more liberal openings up, and there doesn't seem to be anything that would put that into sharp reverse, although, you know, I hope I don't come to regret those words. So this is the kind of story that we've been mentioning. You know, rates are kind of up. Now, I've kind of put them where they were a year ago. So we were at the bottom last year. This is when the 10-year rate was 65 basis points over here. And obviously the Fed had come in with emergency measures. About a month ago when we met, you know, the 10-year was 1.5, something like that. It's kind of got as high as 1.8. It's sort of settled back down to about 1.62. So, you know, things are moving up. We'll notice there's nothing moving on anything below 5 years. And that's mainly because what people are worried about is sort of inflation in the intermediate term, not the short term, but sort of in the 3 to 5 year range. And then after that, people are less worried because they think that the deflationary forces will start to come back in. But this is where, but also because the Fed has got everything tightly anchored at the short end. So, you know, you can see out to the 3 years, absolutely no change in rates, and you can still borrow 2 year money at 11 basis points. but the 10-year has come up a little bit. Nothing to be alarmed about. I think it's more growth expectations than inflation expectations. Although there's a very vigorous debate about whether it's either or both. I mean, I certainly admitted some of both, but I think it's more of more on the growth side. I think the inflation story is a little bit hyped up right now. Yeah, that's I'll skip over that one. This is a kind of a revisit, even though we had inflation numbers today, which were quite a bit higher. So they were 2.6%. You can see way down, 6-9 months ago, we were reporting year-on-year inflation of 1.5%. So it has come up to 2.6%. I mean, I'll explain this in a minute, but no, actually, I'll wait a bit before I explain what's going on. But this is important because this is essentially what the Fed said last August, and they pretty much repeated this story ever since. And even though the Fed speakers are speaking on a very regular basis, there's 2 more tomorrow. I think there's a couple of them yesterday. They're essentially saying this sort of thing that unemployment has to fall to 4.1. Roughly what they said. It's 6% now, and inflation has to get to 2%. Well, they're kind of there, but the two have got to meet. And as you can see, it's only 4 times where they've really met in the last 70 years. So, I think for now, the Fed is pretty much saying, wait for the data. We're very concerned about employment, even though the unemployment number looks reasonably good. They know, I know, we know, everybody knows that the real rate of unemployment is probably twice that. Because you just got so much slack in the labor force, people taking themselves out of the labor market, people not looking for jobs for various reasons. All that, I think, will start to reverse itself if people feel confident that they can kind of show up and go to work. So the unemployment number is understated, and the Fed has said that time and time again. So you've got to wait for these 2 numbers to meet before we really action. This is what I was talking about, the inflation number today. So there's the headline. People said, "Oh, it's the biggest." Reading from Bloomberg, consumer prices in US advanced by most in nearly 9 years. You go, well, okay, yeah, I suppose they did. The month-on-month rate was up 0.62%. So we've been looking at more like 0.3, 0.4% a month. So you have to kind of roughly multiply by 12 to get an annualized rate. And the last time that happened was in the end of 2009 when it was, more like 0.8%. But this is month-to-month stuff, and that, as you can see, you can jump around quite a bit. So that's the headline number. But let's look at the long-term number. See what we got here. And my view is that this is the 2.6 number right at the top. The other 3 are really core. In other words, you take out the volatile elements around food and energy. I know that you have to drive and you have to heat and you have to eat. But the Fed has typically not made a lot of monetary policy changes based on the volatility of those types of price inputs. So they look at the core, that's 1.65%. That still tells me they've got a ways to go. And the 2 blue ones are essentially the inflation measure the Fed looks at. It's slightly different. It's called the PCE rather than the CPI, personal consumption expenditure, for those of you who like to look at these things. And it's a slightly broader base of inflation. It doesn't have as much housing and anything like that. But anyway, my point is, look, you can see here a very, very big deflationary force. We not to give too much of a history lesson, but we kicked out inflation hard, and it was very tough in the early 80s. And then since then, it's been kind of drifting down. You can see it's been sideways for much of the last 20 years. So I can certainly see a period where this 2.6%, trends up just like it did here in 06, 08. We're looking at 3.5% inflation for a while. But, to see it level out there and stay up there seems to me a big stretch. But that's what people are concerned about. We know it's going to tick up there over the next few months, but staying there consistently for a long time just seems to defy what we've been seeing for the last 4 years. So, yeah, we'll see, but I'm not particularly worried about the long-term inflation, although, again, expect to hear a lot of chat about it over the next few months. Yeah, just to kind of give you an idea that I'm not sort of talking one side of the book. The inflation debate, the sort of, inflation's going up, camp item number 1, they point to this and they look, and then this is very reasonable. It says the manufacturing and service company industries, one of the questions they're asked is, how are your input prices going? So if you're a manufacturer, it's how your steel and aluminum price is going. If you're a service company, it's how's your deliveries and your food items going up or something like that. Anyway, it's prices before they hit the final product line. And this is not an indication of 85% inflation. It's just a difference between those who think it's going to go up versus those who think it's going to go down. So obviously more people think prices are going to go up. And that's quite high. Again, we weren't there. We haven't been really in these levels since about the 08-09 period. So there's definitely some input price pressure coming. House prices, the 2.0% is the owner's equivalent rent. This is the one that's taken out of the CPI. This is the official housing numbers. They're running at about 2% year-over-year inflation. But house prices inflation is a very different thing. And what we've done here is smooth them out because they're very volatile. People pay more for a house in August in order to get the kids into school than they are in December, because who the heck wants to move house in January and February in the Midwest? But if you kind of smooth this out, you'll see that house prices have gone up quite a bit. Now we talked about housing in our meetings before. We know that housing activity has been pretty robust over the last year. Part of that is people moving lifestyles, more working from home. You need a bigger home. If you had your job, you kept your job, you're in relatively good shape. Changing home circumstances, but also couple that with a very restricted supply. The lumber manufacturers, housing contractors, and so on. They also had to stop work for 3 months or so last year. They came back slowly, but they haven't been able to catch up. So there's a supply problem, and anyone living in the Bay Area knows that the demand consistently outstrips supply because of the rather arcane building regulations we have. But I think this is something where this is a concern. I think this 2.0% is going to tick up. It's bound to. It has to, just because if you're a landlord, you're going to track your rents based on house prices, and this seems to be a pretty solid uptick here, which is going to continue for a while. This is kind of also in the home builders side. So this is the home builders' expectations. They're looking to build more homes. That's good. But then look at the real cost of a mortgage, 1.35%. So that means inflation's running about 2, let's say, for the average person. We just said 2.6, but let's just sort of split the difference between that and the core inflation. And mortgage rates are 3 and change. So the real cost of borrowing is, it's pretty low here. I mean, it got low in 14, 15. It got very low just after the crash, because no one was willing to take on new mortgage obligations, and there was a huge glut of housing to be dealt with anyway, and with what we call foreclosures and overbuilding. So other than that, this is a pretty decent low cost of having a mortgage. So again, I think that will continue to provide quite a lot of demand on the housing side. This is extraordinary. Obviously, you need lumber to be able to frame your house. And this is a direct result of 2 things. And I would kind of weight it. First thing is the Trump tariffs. For various reasons, the Trump administration, in its wisdom, decided that they were going to put a excise tax on lumber coming from Canada. So that was, Canadians make cheaper lumber than they do in America. So that pushed up prices and increased transportation costs and so on. That was the first kick. We started to see that up here in 17, 18. Then the supply caught itself out. And then the lumber started going up a lot last year. Again, some of the tariffs were still in place. They kind of absorbed that, but also the lumber mills absolutely closed down, for 3 or 4 months. So there was, buildings going on. They still need the lumber. It's very difficult to shut down a building site completely. So the spot lumber prices, increased quite a bit. And that's raw material that feeds directly into housing. Now, I don't know if it'll continue like that. There's plenty of lumber around. It's getting the people to mill it and get it turned around into the supply chain. So, but anyway, this is one reason why, if you're looking to have your deck redone right now, it's going to cost you a small fortune. And the final one is just we just threw the Crb index. It's just a commodity index, just it's got a little bit of everything in there. It's got metals, precious metals, so nickel, aluminum, lithium, of course, doing a lot of battery stuff, and as well as some agricultural prices, as well as some energy prices. So that's a pretty big gain. A lot of it's driven by energy. It's also driven a lot by some of the mining companies and the metals and so on, which again closed down, saw demand drop off a cliff about a year ago, and now they're kind of back online and they're able to sell to the highest bidder. So there's some definite increases coming through in metals. And I don't think it'll come through in broad inflation. It might a little bit, but not not for a long period. It's definitely something we've seen this before. You see spikes in commodity inflation all the time because it's a very cyclical business. But right now that's a pretty good number, pretty high number. And so for those that are in the inflation camp, I totally get it. The case for low inflation seems to me that there's a lot of labor out there, either who are just taking themselves out of the labor force temporarily, maybe some permanently, but some temporarily. They can't get home care, they can't get school care, so they're having to sort of just not go to their jobs. And obviously in the in the leisure sector, there's still 3 million people less working than there were a year ago. So that's people who are in hotels, sporting events, travel, accommodation, those kind of things, food services. There's still a lot of jobs which are out which need to be filled. It's just that people are not registering themselves as available for employment. So employment cost index, I just look at it's unfortunately it comes out quarterly, which we're kind of waiting for we haven't got the first quarter yet, but 2.6% seems to be a perfectly fine cost for employers to be able to absorb. So that's not showing up here right now. The hourly wages is, but as I mentioned before, and that looks like a terrible spike, but that's really the lower paid people who lost their jobs more than any other group last year, dropped out of the workforce. So if you're earning, $40, $50 an hour, equivalent of, a year ago, actually I know it on the weekly number, it's about $1,200, $1,400 for office workers a week. And then leisure and hospitality earn $400 a week. So if you kind of take those guys out of it, it looks like the rest of the population's had a pay increase, but they haven't. It's they're not earning any more than they did a year ago. This is just the bottom cohort dropping out. So I think we have to wait for those numbers to settle down before we can read too much into them. The other one for low inflation is that the NFIB, we come back to this National Federation of Independent Businesses. These are small companies. 40, 50% of the American workforce is employed at companies with less than 200 employees. So we really look to them. And are they saying, is this a good time to expand? And what are their compensation plans in the next 3 months? Well, very few of them expect to start increasing compensation. In fact, it's pretty much the same level as it was coming out of a very deep recession back in 2009. So there's no sort of compensation pressures coming from the NFIB. And in terms of saying that a good time to expand, well, it's better than it was a year ago, where only about this is the Fusion Index again, so only about 5% more people said it's a good time to expand. But when the heyday of NFIB gets very excited about tax increases and deregulation, and can understand why they bear a lot of taxes. They can't hide their taxes overseas like large companies, and they have to put up with a lot of local regulations. So they were very bullish in the early Trump years, and obviously that just melted away in the 2020 COVID. So it's back a little bit, but it's certainly not at any kind of record levels. And we should mention this. Yesterday, the monthly Treasury statement came out. The monthly deficit was 600 billion. Those of you with longish memories will remember that that was a pretty good number for an annual deficit a while ago. So yeah, the deficit is going up. I don't know what it'll be for the year. It could be 2 or 3 trillion, 15% of GDP, which is GDP is 21 trillion, so 10% too. So it could be higher than that. So it's projected to grow. Now, again, those of you long memories will know the twin deficit story from the 80s, massive current account deficit, massive budget deficit. We're on a train to hell. you know, the debt clock is ticking and it's incredibly dangerous. Well, it isn't. You know, the federal deficit is being, I think, used in a good way. It is using it in a kind of a classic Keynesian sense of, you know, for putting in demand to the economy where there is no demand. And interest rates are at a record low. Therefore, interest payments as a percentage of the budget are at incredibly low rates. So it's never been cheaper to take on debt. And you know, if you're sort of looking from a business point of view, you can borrow 10-year money at 1.6%, and you can get a modicum of return on that capital. You're really talking about, you know, negative rates of return. So if you build a bridge, you know, go back to the infrastructure product, and if you can't get more than 1.6% internal rate of return on a bridge, then you probably built it in the wrong place. So I think that this is not something that we have to worry about. Right, it doesn't really put any upward pressure on rates recently. Yeah, jobs. So jobs are beginning to move. We had some scares here where, you know, after these two numbers add up to 22 million. This is a very weird logarithmic graph, just because you know, we were used to 200,000 or 300,000 new jobs a year for the last 20, 30 years, and occasionally, you know, you've got a 600,000 loss in the like 2008 recession for 1 month. So we had 22 million last year. So that's why the scale looks so weird. But look at the top further on the right. So we were about 380,000 in February, and then we popped up to 916,000 in March, and that's good. Now that rate will be back to pre-COVID employment levels in about a year, because we still got about 8 million jobs to fill. But you know, at least it's in the right direction. And then this black number is what I was discussing earlier as the real employment rate. But anyway, real unemployment rate, nearly 11%, nearly twice what the official one is, the 6% here. So that seems to be going in the right direction. They can put that in the column of, you know, good things. If we get another good print, you know, 800,000, anything over 700,000 would be great for April. Then, you know, we'll know we should be in good shape for the next few months. So that's a good sign. Q4, it's a history books now, but it went up to 4.3%. It got revised up a lot. So during the quarter and then after the quarter, so that's a good sign. Current estimates for the current quarter for the fourth quarter, first quarter of this year about 6%, for the year as a whole about 6% as well. So that would bring us a long way back. Not quite back at the level again pre-COVID. We're still, you know, below trend by quite a bit. But if we can clock in a GDP growth at 6%, that would be one of the best in the world. And certainly among the major G7s, other than China, whose numbers are always a little bit weird, it'll be probably at least twice its nearest competitor. So there's some good signs that, you know, GDP growth is coming back strong. That's a real testament to, you know, how the reaction to the stimulus and you know, the kind of flexibility of the US economy. Europe would be lucky to do 2 this year. Consumers, gosh, they are saving like crazy. So you know, this yellow line is the savings rate, and you've heard for years that Americans are bad savers. When they redid the numbers at the end of last year, they found it wasn't quite as bad as they thought. The savings rate, if you and I are having this conversation in the early zeros, or the 90s, they're talking about in savings rates about 2%. They redid the numbers a few years ago, and they found out it's probably more like 4 or 5%. Don't ask me how they, it's a long, complicated question, but I think these are the numbers more likely what the Americans save at. Now, the important thing is that obviously they didn't have anything to buy, so they were saving like crazy at the beginning of 2020, and the inflation went up, the savings went up to 35%. So $1 in $3 was essentially not being consumed, being saved. Now it's come down a little bit, and it's popped up again. It's really, the reason it's so jagged is because it coincides with the passing and the stimulus bills and money getting into people's pockets. But the thing to look at here is that there's an awfully high amount, 2.4 trillion, well over 10% of GDP in savings account. We're not talking about investment. People don't have to liquidate that Tesla stock to get this. It's just going to the bank and switching it from your savings account to your checking account. Boom, it's there, ready to save. So these are ready to spend. So these are very high numbers, and I think that supports the relatively quick return to demand once we're open. We've had a great year. it's not often you get a 1-year number on the S&P of 50%. Briefly, about 3 weeks ago, the 1-year number was 75%. Thankfully, it didn't stay that level for too long, because obviously the correction we had back in March last year was thankfully over in fairly quickly. The 3-year numbers are very flattered, 18%, so are 5, and so is 10. The 20-year number's more what we would think would be the kind of long-term rates of the stock market, close to about 9%. Could get higher. It has been consistently, higher than that, but I think for planning purposes and everything, we aim a little bit lower. And when I see the 20-year number at 8.8%, that seems to be like a relatively good number to bank on for the long term. We'll obviously get a lot more spikes. So this is thankfully a return, because we had a lot of negative stuff a few years ago. On the S&P, this is what happened in 2020. So it was very much led by the large cap. So the total, the S&P 500, which you all hear about, was up about 18% in 2020. And then the equally weighted S&P. So in the first index, Microsoft, Amazon, Google, Tesla only came in at the back end of it. Who am I missing? Facebook, Apple. They were like 25, 30% of the index. In this equally weighted index, only one, because every company is weighted at 0.2%. So what you're looking for is, has the average stock participated in the rally? And it hadn't. If you can look at the bottom here, it's sunk lower, and it took a heck of a long time to get close. It hasn't even still got close, at the end of 20 to the cap weighted one. So this market wasn't very broad. We talked a lot about this last year, that it was being led by a number of star players, COVID beneficiaries, and so on. So that's the actual kind of numbers. But things started to broaden out over the last since October. So now the average, think of this equal weighted return, that top line, I think it's green, I'm not sure, but that's up 28% since like October, and the average market is up 17%. That just tells you the average stock was up 28%, whereas the other one tells you that the whole index was up 17%, and only a few companies were probably up that high. So when you see a market broadening out, that is unequivocally a good sign. When you see the markets are led by one sector, tech getting up to 30% of the index, 5 guys, and all tech companies, but those 5 guys at 30% of the index, then you got some legitimate cause to worry. But it's broadened out now, and that's been a very nice thing to see. It's also true here in smaller companies. I took the top 5, so they were up 43% in 2020, so you couldn't really put a foot wrong there. I think this was up to September actually, and then the mega cap, the top 100 were up 8%. But the important thing here was the lagging guys, the small cap. January to September was down 17%. So this was very much a top 5 led market. Well, again, it's changed a little bit, and here we are actually. Sorry about it, it's not over 3 months; it's since October, but you can see that the small caps have raced ahead, up 43%, mid caps up 33%, and then down at the bottom, eking out a 9% return, which is a pretty good number. But when you're looking at small caps up 43%, obviously that leadership has exchanged. Again, unequivocally a good thing. You don't want to see a market so focused and so concentrated that there's only a few players telling all the story. So broadening out is a good thing. Yeah, valuations. There is no way to say that this market is cheap. In traditional valuations, we take price earnings or price to cash flow, price to book, price to sales. There's dozens of these valuation metrics. You can take them any which way you want. You can exclude stuff, adjust seasonally adjusted, time weight adjusted, plug a gold and silver number into it, whatever you want. But there's thousands of them. But basically, you're not going to find many indications that the market's snortingly cheap. The only one I kind of would put some emphasis on is that the earnings yield, which is the reciprocal of the P. So it really tells you what's the P, what's the S&P earning as if it was like a bond. And surely the answer is about 4.4%, which is not as high as it was a year ago. But in real adjusted terms, it's not too bad. So the lower the number, the more expensive it is. So market was ridiculously cheap a year ago, ridiculously cheap at the end of 2012. In fact, I think we said so at the time. But it has been more expensive over here. But this is definitely a challenge. But hey, we're not down here in 1999 levels. So it's okay. Not great. It's not okay. It's okay. And I just say, look at the long-term perspective. This is the S&P. And there are periods where the thing goes sideways. I mean, between 97, we all had a good time in late 90s, but essentially this market was flat for 13 years. If you bought in 98, it took you till 2013 to make your money back. Now you could have bought along the way and made some good money, but essentially if you just bought an S&P 500 index fund, excluding dividends, which is worth about 2% a year, so not trivial. Essentially the price, the NAV of the S&P 500 SPY index didn't change. So it's only now we've kind of seen, a healthy breakout. This happened in the 70s for sure. So, I take some comfort in this because, again, it comes back to this 20-year number at, 8-9%. That's not, too devastatingly high that you're worried that the market's got to fall out of bed, doesn't it? We had a long period here where essentially we didn't make a lot of money in the index, other than if you were dollar cost averaging. So anyway, that I think gives me some pause for thought and good thought that the market taking a breather. Obviously, another record high today. I don't think we're looking at a big correction, yet alone a crash. I mean, there's nothing to stop the market going down 5-10% because inflation number comes out bad. Powell gets hit by a bus, God forbid, or something like that, or one of the tech companies gets regulated or comes up with some scandal. All these types of things are natural risks that the market might have, and we're never immune to those types of things. But in terms of the stock market being relatively well underpinned, especially given the revival in the economy and coming back to very robust growth, both in broad numbers and population, I think we're in good shape. So we're on track for herd immunity. Huge pent-up demand. I think we've covered that. It is going to be big. Just think of your own circumstances about things that you're going to do, postpone doing. I'm hopefully getting on a plane in May. Nowhere glamorous, just not back to Texas. But I haven't been on planes since January of 2020. So I'm sure there's a lot of people like that, and that'll help the services side a lot. The next few months, you're going to see a lot of inflation talk, and that's just, again, the base effect. Plus, think about a restaurant that's opening up at half capacity. It's probably going to have to raise its prices because it needs the same staff, whether it's serving 50 people or 100 people. And if they're restrained from having a full opening, either the regulations say they can't, or people just want to be further apart, then to feel more comfortable to get them in. So plenty of businesses I could think of, having increases in prices. Airlines for sure, they've still got, thousands of planes white-tailed out in Arizona, which have just been taken out of commission and not being used. And so I'm sure they'll be on some popular routes. They're going to prices, especially as energy prices are 20% higher now than they were a year ago. We might see some labor market, may see some wage pressures, but I think participation is going to increase. It takes a while to get people back into the labor market. They've got to feel settled, got to feel confident, got to feel there's something's available, and the pay has to offset the costs of providing any kind of home or childcare, which a lot of the population does. Especially for women, the labor participation for women has fallen off a cliff. And if to get that back, you're going to have, I think, to see people feeling more confident they don't have those expenses. But I think the participation will gradually increase. Now, as far as the Fed's concerned, we've said what they're going to say. Then they're going to just stay rigid on we want to see the data. We want to see, employment up. Talked about employment a lot, and not just looking at the unemployment numbers. They've talked about employment, for groups of people who are typically have, 2 or 3 times the average unemployment rates. So minorities, women, city groups, and so on. So they're taking a pretty bold mandate because they made a mistake after 2008. They tightened too quickly because they looked at the employment numbers and said, oh, we're just that old standard inflation, employment, Phillips curve trade-off. So if unemployment's above 4%, falling 3%, it's going to be inflation. Well, it never happened, and a lot of that relationship broke down, and the Fed tightened, too early, and you had the taper tantrum, and then Janet Yellen put rates up at the end of 2014, and then waited 15 months, pushed to the next one. There was never any inflation pressure coming from the low employment numbers. So I think they're going to wait until they really see that employment number pick up in a broader sense than just looking at the headline inflation. And remember, they're not going to raise rates first. They're going to taper first. They're buying $120 billion of securities every month, treasuries, and $40 billion in mortgage-backed securities. So that's a lot. That's a lot of billions, and certainly helps to fund some of the deficit for sure. But the taper, there's absolutely no talk about tapering yet. They might sort of towards the end of that this year if things are really going well, but they'll do that first. And if they telegraph it properly to the market, there shouldn't be any concerns on that. And I'd say don't expect anything late 2021. I'm going to stop sharing at this point because I open up to some questions. Thank you very much for staying with me here. I know we've covered a lot of ground, but there's been a lot to talk about. I would just mention the infrastructure bill. I don't think it's going to get through at the 2 trillion level, and obviously there's a lot of noise about the corporate tax cut. But I think what Biden's doing is very clever, because he's invoking the sort of OECD to be able to create a level rate of corporation tax wherever anyone's domiciled. So that'll make it a lot harder for the tech companies to book their profits through Ireland or the Netherlands and Singapore and various islands down in the Caribbean. So if that gets through, there'll be an automatic increase in revenue from corporation tax. As far as moving it from 21% to 27%, I think the number is 28. The number is 35 with before Trump moved that number down. And we weren't exactly hurting at that point. So I think that the business sector can take a smaller increase in corporation tax. We're not going to go back to 35%. And the numbers that might come out is sort of like 25%. I think you'll barely see it. You'll see some revenue increases. You won't see much in the way of companies having to pare back or anything. And in terms of getting infrastructure built, I mean, everyone knows the last 30 years we've been living on borrowed time with the infrastructure projects. I mean, everything's crumbling. If you live in somewhere like the Bay Area, you know how much wasted time there is, and productivity just slumps when you go sit in the car for 2 hours a day. So if that kind of stuff, I'm not saying we'll get an answer straight away in the Bay Area, but if you look at the country as a whole, and infrastructure spend has enormous return on capital. And so that could be quite good. We just got to look at it in the kind of medium to long term. It doesn't happen overnight, but I think it's a net positive for sure. Carolyn, I don't know if you're on the line. I've been joined here by Carolyn O'Neill, who's making sure everything's working behind the scenes. Yes. Sometimes we have some questions. Oh, hang on.
We have 2 questions waiting for you, Christian.
Yeah, there we go.
Can you see them, or would you like me?
Yeah, I can. Great. You seem less concerned about inflation and higher long rates than many. How do international yields factor into that? I'll take the first one first. I don't think I'm unusual here. I just think that, if I could, Bloomberg's pretty cool most of the time. This is a stupid headline, just to say, most advanced in 9 years. Like, they could have written that a week ago. Everyone knew it was going to happen. So I don't think, I don't think a lot of investors are particularly worried about it. I might be wrong on this, but I think the press is just having a field day on it. So I think I'm not sure if I'm less concerned than a lot of people. But and I'm not worried about long rates going higher because the Fed is sitting there saying they're going to keep low rates pretty well anchored. So there's a limit to how far the 10-year can spring up. If you've got 0% on the Fed funds and 11 basis points on the 3-month, and international yields factor in a lot. That's a really good question, because German bonds are negative to 11 basis points, something like that. For 10-year number, Japanese bonds. These are really the only guys that compete against the US for international flows. They're at about 70 basis points, so less than half what the US has. And as long as those rates are low, and they'll stay low, I mean, the ECB and the Bank of Japan are buying like crazy, and that's their policy, then I think it's very difficult for the US rates to explode much higher. It puts an awful lot of pressure on the dollar. So I'm maybe a little bit more sanguine about long-term inflation. So no problem. The next few months, we're going to get 2.5%, 3% prints, and people are going to get freaked out. But I don't think we're going to see those numbers, in there for the long term. Any projections on impact of chip shortages to the market? Yeah, that's a problem, and I think that it's a supply chain problem more than anything else. Hello.
Hi, Christian. Welcome back.
Yeah, sorry about that.
Sometimes it happens. Everybody's pretty much hung on here. So
okay, I really apologize. Yeah, no, my laptop went from 20% battery to 0 in 2 seconds. So I thought I can't see the screen line right now, so I can't read the questions. But could you read that second question if you still have it?
Yes, he asked any projections on the impact of chip shortages to markets, and that's what you were answering.
Oh yeah. So that's a big deal. Yes, there's definitely supply problems. I think Taiwan Semiconductors, the big supplier in this, and I think there's been huge demand from Bitcoin miners. So Bitcoin, as you know, is a tremendously energy intensive activity, and there's been a lot of farms and servers which have been pressing on the demand for semiconductors. But of course, the other one is electric vehicles. I mean, everyone's jumping into electric vehicles, not just the Teslas and the Neos, but also the mainline car companies. So I think that's got to work its way out, and I think that will be that's a classic supply chain problem. It's going to take some time to resolve. I mean, the US has talked about bringing some fabrication back to the US. Intel's talked about that. I think they probably will, given that the last year has just shown how fragile some parts of the global supply chain business there is. No one wants everything to come from TSMC, given all the problems over there. So I think we're going to see some continued problems on that side.
That was it for the questions. You answered the other one.
Okay. Well, thanks very much. Thanks for holding on. Sorry about losing you there, but I'll remember that not to take my battery read too literally. And I'm going to hand it back to Carolyn for reading of the disclosure. And if you have any questions, feel free to email us you can find us on our website, see Thwaites one at bnjadvisors.com. Thanks very much.
Thanks, Christian. Here we go with the disclaimer.
Okay.
This presentation is for general informational purposes only. References to an individual security should not be construed as a recommendation to buy or sell that security. The securities mentioned in this commentary are only several of the successful as well as unsuccessful investments by us and do not represent all of the securities we have purchased, sold, or recommended. Although we deem reliable the sources of statistical and other information referred to in this commentary, we cannot guarantee the accuracy or completeness of any statements or numerical data. Past performance is no indication of future results. Thank you.